Good afternoon, everyone, and a very warm welcome to the Mesh Experience webinar, where we'll be delving into our retail banking study to look at the performance of challenger banks within the context of the banking category, and looking at what traditional banks may learn from what the challenger banks are up to. Just in case there's any confusion, we are actually broadcasting from an office in central London and not out in the wilderness as the backdrop might suggest. That's just a very lifelike painting that we're very fortunate to be sitting in front of. My name is Barrett. I'm the regional lead, or the MD, of the UK and EMEA region for Mesh Experience, and I'm joined by my colleague Mark, who's an experience director here at Mesh Experience. The presentation is kind of in two parts. I'm going to take you through our philosophy at Mesh Experience on how we approach brands and our thinking, and then a little bit a quick overview of how we've collected the data and how we collect the data for our retail banking study. And it's this data that we've interrogated to bring you the insights regarding the performance of challenger banks. And Mark will take you through that part of the presentation. So firstly, experience-driven marketing. At Mesh, we have a really simple thought, which is it is the experience that people, it is all the experiences that people have with a particular brand, not just the paid experiences, that shape people's perceptions of that brand. So we think about all the experiences in a holistic way. And if you look over on the right of the slide, you'll see that's a quote from Mark Pritchard, who's the Chief Brand Officer at Procter & Gamble, just to demonstrate that more and more senior marketers of senior brands, right across not just the banking category, but FMCG and all other company categories, more and more people are beginning to understand and realize and recognize the importance of the consumer experience, and the fact that all those experiences should be measured, and people within the organization, especially marketers, become responsible for, in order to drive brand health and in order to drive brand growth. So, next slide. So, in order to do these things, as marketers, we need data. And currently, we are awash with data coming from all sorts of sources. We're looking at share of voice, we're looking at likes on online stuff, we're looking at GPRs or GRPs even. And it can be really difficult as a marketer to make sense of all the this data, you know, in this work, in this time of huge data, as we call it, and trying to connect all the dots to kind of get a single view or a single insight can be tricky. So what we've done at Mesh is thought about, well, if we could look at this data, but look at it from the customer's perspective, understand how a customer is experiencing your brand, your competitive brands within the real world context, then suddenly the data starts to make sense and we get a better view of how we can ensure that our customers are getting the most from our brands, and then therefore how we can grow our brands. So the principles of our approach is literally from moving from a disparate and disconnected source of data to a unified view, a view through the customer's eyes. One data source where we're collecting all experiences within a category or a group of categories, but in this case, the retail banking category. And not are we collecting what people are experiencing and when they're experiencing it, but we're also collecting in that same data source how the emotive response to those experiences. And therefore, we're able to see what's really important to a customer, what experiences are actually reaching them, what messages are resonating with them, and how do your messages and your experiences compare with other brands. So a bit about the methodology and how we actually collect this data. We recruit from a panel, and every month we recruit 400 people. And over the course of a month, we collect about 2,000 experiences. So the retail banking study has been running for about 2 years now. And over that period, we have over 65,000 customer experiences across over 12,500 consumers. So the way it works is that as a panelist, as a participant comes on board of the study, we do a quick survey, which is a 15-minute online survey, which they can either take on their laptop or on the mobile phones. And that survey is literally capturing brand health metrics like spontaneous awareness, image statements, cultural affinity statements. So we get a picture of what their current perception is of brands within a particular category. And then for the next 7 days, we ask them to keep a mobile diary. And we ask them to tell us about any experience they've had with any of the brands within a particular category. And that experience can be as simple as having a chat with a friend, or calling the call center, or accessing a mobile app, right up to TV advertising, press advertising, out-of-home advertising. And we cover over 100 touch points. Once they've completed that diary over a week, as they're having each experience, we ask them two basic questions. How did that brand experience make them feel? I.e., how positive was it on a scale of 1 to 5, where 1 is negative and 5 is very, very positive. And then we also ask them, how persuasive was that experience on a scale of 1 to 5? So in other words, how more likely are they to consider the brand going forward as a result of that experience? So we capture all those for a week. And then at the end of the week, we then re-survey them in a survey which is very similar to the pre-survey, where we recapture the brand health metrics and imagery measures and things like consideration, trust, those sorts of measures. And what we're able to do through analytics is then compare the metrics pre-experiences and post-experiences, and then detangle which experiences are driving which metrics. So, as a result of the thinking, we have a very simple model of how we use this data. So, through 12 years of collecting data across many categories through our real-time experience tracking methodology, we've learned that the share of experience is a better correlator with share of market than is share of voice. So, if you're a brand that wants to grow, then what you do is you increase your share, the quantity of experiences you're having within a particular category, and that starts to drive growth. So working with our clients, this is the area that we spend a lot of time with, is helping them understand how you increase your share of experiences to drive growth. But it's not just enough to drive the quantity of experiences, you also need to drive the quality of the experiences. So it sounds very glib, but it is the positive experiences that we need to focus on. We know from the data that we've collected and the analysis that we've done that a positive experience is 3 times more impactful than a negative or neutral experience on a metric like brand consideration. And so through all the data that we've collected, particularly within retail banking, we really understand what a positive experience is and how to create them. Now, experiences are created in channels, both combination of paid, owned, and earned channels. Through the data we've collected, we now understand how positive particular channels are, and how within those channels you drive positive experiences. For example, we know that cinema, an ad run in cinema compared with run on TV, that the cinema ad is significantly more, it creates a significantly more positive experience than does the same ad on TV. And in particular, a brand like Nationwide is really benefiting from this and does this really, really well. So now we know which channels are positive and how to drive positive experiences in those channels. What are the propositions within those channels that are most positive? And then not only, what about the placement of those messages? For example, we know the difference between running a particular proposition in a 6-sheet poster versus a 96-sheet poster, and the nuance on which propositions are more positive in which particular medium. As well as placement, then there's also context. So what else is happening in the world that might be affecting people's brand perceptions with a particular, and the experience with a particular brand? So in a time when there's lots of negative news about banking in particular, how is that affecting people's experiences of of banks. Aligned with that, when you are running campaigns, when should you be running your campaigns in terms of the media that you've chosen? So, for example, we've understood that running financial services advertising at the end of the day is much more of a positive experience than it is at the beginning of the day. And all this is done within the context of your competitors. So, you begin to understand how your customers are experiencing your competitors' brands and how your competitors' consumers are experiencing your brand, and how each of those experiences influences a customer's or a consumer's or a prospect's experience with your own brand. So we've kind of bought, for us, the key metrics that we report out on with our clients are experience reach. So how many people are you actually reaching through your paid, owned and earned media? And particularly within the paid media, what we're actually picking up is, what we're actually reporting on is, what you're putting out there, but we're measuring what's actually being picked up by consumers. And that's what makes it really quite a powerful way of understanding whether the communications that you're putting out there are being noticed and are cutting through. We've already talked about experience share and how that correlates better with share of market. And then we talk about experience positivity and experience persuasiveness to help us really understand the quality of the experiences that people are having. So hopefully you now understand the methodology and our philosophy. I'm now going to hand over to Mark, who's going to talk you through our findings with regards to challenger banks in particular.
Cool, thank you very much. So for the next 20 minutes, I'm going to take you through a few kind of key questions which we've shaped the presentation around. And ultimately what we're looking to understand is the role of challengers within the retail banking sector, how that's changed over the past couple of years, and what threat do they pose and how do other banks kind of compete or can respond to this. A lot of the data we're looking at here is taking over the past, from April 2018 to March 2019. And the reason for that is we're launching our annual report this year very soon. And each year we take the data set, we look across a full year's data, so we have all of those experiences that have built up over the year, and we can start to deep dive into those. So as well as looking at the data on a monthly basis ongoing, we produce an annual report, and a large amount of the data here is based around that. So initially looking into what threat do the challengers pose? Well, firstly, if we look at just some basic measures of awareness, we can see that relative to the big banks, so Barclays, HSBC, Halifax, Lloyds, etc., awareness for the challengers is much lower. It's both from a total awareness level, but even more so from a top of mind or spontaneous level. So even the biggest challenger, such as Virgin Money, despite having 64% awareness, kind of staying stable year on year, has a way to grow for total awareness. But I think more importantly, the top of mind awareness just really isn't there for the challengers. So whilst there's a lot of noise or talk about them maybe within the industry, actually from a customer's perspective, it's still not being the brands or the banks that are most forefront. And coupled with that, if we look at consideration, again, there's still that really big gap between Nationwide at the top and the challenger banks. So again, Virgin Money in the middle there, around 13% consideration, although it's slightly lower than last year. But a lot of the other challengers like Monzo, Atom Bank, around the 5-6% mark. So again, there is still that room to grow awareness, but also that needs to then convert into consideration. One area we have seen that has been growing, if we look at our experience data, is the share of experience that these brands are contributing towards. So again, this is looking at data from April 18 over a year to March 19. And looking at share of experience, what we do is we take the total number of experiences over that time period, and we look to see what percentage are driven by these challenger banks, so Atom Monies, Monzo, Tandem, Virgin, Vidor, Metro and Starling. And what we can see in April 18, they represented about 2.5% of their share of experience. And that's grown throughout the year, leading to the latest data in March 18, up to around 4%. So really we see that trend of increasing the share of experience. And what this means is they're essentially becoming more present. So they are being experienced by more and more people, and capturing a higher percentage of all experiences. But I think what was more interesting when we looked into not just the share of total experience, but the share of positive experience. So rather than looking at all experiences over a time period, we looked at grouping together the positive experiences. And we looked at the same measure to see how the challenge is performing over time. And again, what we can see here is a similar trend of increase, but actually at an increased rate versus the previous slide. So what that means is that challenger banks are increasing their percentage of share, but more importantly, they're generating more positive experiences. They're capturing a higher share of the positive experiences in the market. And as Barrett previously mentioned, in order to grow your brand, you need to be more present, so you need to have more experiences. But you also need to be more positive. So within that, drive a higher share of positive experiences. And that's what we're seeing coming through from the challenger banks. Now, something we looked at last year, which has remained consistent this year, is where those experiences are coming from. So for the major banks, around half of all the experiences, so half of how people see or experience a bank, is through paid media. Obviously, TV within that is the highest reaching. Followed by owned around 38%, and fewer earned experiences, such as conversations, word of mouth, newspaper, TV. Actually, compared to challenger banks, we see quite an even split across the three media. But I think the big difference, where we see the big difference, is through earned experiences. So much higher percentage of earned experiences, showing that word of mouth, that conversation has been driving a lot of the ways that people are experiencing the challenger banks currently. But I think what's interesting again is we are starting to see this change around. And we've looked at the paid reach for the challengers from April 18 through to a more recent time period of June. And the reason we did that is because we wanted to show that, in particular in the last few months, we've seen a real big increase in the paid reach from challengers. So clearly we can see that they're starting to use paid media as a way to increase growth and to kind of push on and supercharge their growth. One experience, or one recent example of this, is Monzo, who've had first TV ad campaign following on from a series of out-of-home adverts recently. And within some articles and what Monzo are reporting is insane growth in terms of the number of sign-ups as a result of this. And I think whilst this is true in the short term, we have seen that that reach has increased, and therefore increasing that reach is helping to grow numbers. Actually, what we want to look at, what we've been looking up at, is what impact does that experience have from a brand perspective, from an in the moment engagement. And actually, for Monzo's recent campaign, particularly through TV, we saw more of a mixed response. And for some participants that we've picked up on, their experiences were almost that the ads weren't necessarily aimed at them, or they didn't feel that it was the right kind of brand or product for them. And this might be a case that actually the TV ads that Monzo are releasing at the moment aren't for this audience. But actually, in order to kind of grow the brand and really be a challenger brand and reach that mass market, then we will need to be impacting and engaging this mass market audience, which at the moment the ads out there don't seem to be doing. So in June, when we looked at the performance of Monzo's paid media versus the other banks, we see that the real established banks of Lloyds, HSBC, Halifax, Barclays, Nationwide are really outperforming Monzo in terms of the positivity, so how positive people respond to and are experiencing the paid media, and also how persuasive they are. So whilst this might be potentially just a one-off, I think it's an interesting early sign that will Monzo and some of the other challengers struggle to engage the mass market audience as they move over to use paid media and TV to kind of grow the brand. So I think an early warning sign of maybe, whilst initially the sign for growth is about generating that awareness, building that up, actually to sustain that and to really push on, it needs to be engaging these audiences. So what is it about their experiences and the Challenger brand experiences that are really positive or delight people? Well, how we typically look at this is on a chart like this, where we map positivity, so top two box positivity on the horizontal axis, and persuasiveness, again, top two box on vertical. And the size of the bubbles are the number of experiences. And we know that in order for banks to grow, they need to be generating positive experiences and increasing their share of experience. And we see Nationwide, which was ranked #1 in our league table this year, is really leading and has been leading from last year, followed closely by First Direct. But actually, this isn't the complete picture. And if we expand this out further, we see banks such as Atom Bank and Monzo are really far ahead in terms of their total experience positivity and persuasiveness. So again, this is grouping the data across all experiences and the year's data. And we can see that generally, whilst the reach is still not as big as the other banks, actually the quality of experience is there. So really what the danger is if they maintain those quality of experiences and continue to grow by attracting new customers, then that is a real watch out for other banks. Some of the things that really delighted people, so where we are seeing those really positive experiences from Atom Bank in this case, but challenges more generally, are related to some of the offers and the rates that are advertised and that are available. In addition to this, so endorsements has been a thing that's come through, a few different examples whereby people are seeing recommendations from maybe Martin Lewis or from Money Saving Expert. And this is really helping to enhance the positivity for these banks. And I think what we'll come on to later is potentially in the absence of maybe more familiarity, these endorsements are really helping. As well, a lot of people are talking about the ease of setting up. So being able to do these much more easier. So, and again, in the past, the perception of switching and opening accounts has been quite a cumbersome process. But actually, people are picking up from conversations, word of mouth, that this isn't the way with the Challengers, and they're very easy to set up an account. In addition, the functionality has come through. So here, in terms of budgeting, a lot of people talking about the ability to budget and to save is a real positive aspect, and the control and security that they offer. And this isn't necessarily security in a broader sense, but actually being able to see transactions they happen, understand that you can freeze your card and unfreeze this when you need to. These things that I think give customers more control have led to the ability for people to feel more secure with their money and with these banks. In addition, the spending occasions, so being able to either save for certain events or used as an additional account abroad, again, have driven positivity through discussion. And finally, the conversation or the communication, the tone of voice these banks use is has been quite different to what traditional banks have communicated with their customers. And whilst this might not be for everyone, again, the positive examples we've seen really respond well to this and actually find that they're banks that kind of talk to them in a more human way. Now, a lot of these may not be factors which other banks can't offer, but I think together with the look and feel and the freshness of these banks means that for the people they are interacting with, engaging with, they are delivering those real positive experiences. So I guess, as we saw earlier, the question is, and the challenge is, how will this convert as we move forward and as they start to grow? Can they keep this freshness and this look and design once other banks start to, use some of these functions and features to engage with their own customers? So quickly, if we look at which audiences are responding best, firstly, taking the where we're seeing most experiences, so which audiences are experiencing, in this case, the fintechs most, it is younger customers, so under 34. It is a slightly more male skew and slightly more southern based. And also, if we look at the profile of income, it's those with a slightly higher income. So whilst this may not be much of a surprise generally to what you probably already know about challenger banks, what we find, which is really interesting, quite dramatic, is that when we looked at how positive experiences were across all of those different age groups for the market average versus for fintechs, we can see that across the board, regardless of demographic or what they're reaching, the actual experience itself, so when they do reach someone, the experience is really positive. So if we quickly look at age, we can see that the 18 to 24s and the grey bar generally are more positive about all banking experiences. And we do see that really big gap between that and the orange for the fintechs. So the fintechs, on average, about 75% of experiences are very or fairly positive. But this stays consistent across all age groups. And interestingly, if we look at that 55 to 64 segment, whilst on the previous slide, they're not really reaching or engaging as much with this audience, when they do, again, those experiences are really positive. So again, this is a watch out or a danger where, it isn't that they are necessarily responding or only working really well with an audience. It's just that at the moment, certain audiences are the ones that are, engaging with them. So a couple of slides then on how some of the more established banks are responding, or some of the factors which maybe aren't working as much into the favour of challenger banks. Two of the kind of main themes around what makes it necessarily not relevant or not applicable to everyone is firstly is around awareness and familiarity. So we saw earlier that awareness isn't necessarily there for the mass market. And familiarity takes a while to build. So a lot of the late majority or laggards aren't going to be comfortable kind of switching to these banks at the moment. And that's something to kind of face in the future. And as well, there's an element of functionality. A lot of the negative reactions we saw towards challengers is that there isn't that human presence there. So there isn't that kind of branch that people can go to, or maybe there's a bit of a fear around digital and safety and security that, again, these banks will need to address moving forward. One of the ways which we looked at this last year, which has remained consistent this year, is where we looked at the difference between trust and innovation. So whilst the banks such as Atom, Style and Monzo are seen as really innovative, there is a way to go to increase that trust, which is such a key factor for banks. So we see that space in the middle where Nationwide, Barclays, Halifax are playing. That's where the Atom, Monzo and the likes need to kind of push up towards to be not only seen as innovative but be trusted and responsible and reliable. Some of the responses, which may not necessarily be direct, but have certainly been in relation to, we've seen Halifax, for example, with its new rebrand and its kind of Make It Happen campaign. And this has been responded to really well from participants. It may not have been pushing persuasion, so making people more likely to consider the bank, but actually what it's done is put the brand in a really positive light. So with its fun style and upbeat creative, people are feeling very positive towards the brand. And this is something that the challenger brands have done really well, is that they have generated this general good feel and look about the brand. So interesting to see that that's where Halifax is moving towards, and we'll see this kind of follow through to how this is making the brand kind of remain more at top of mind. In addition, and I think one of the interesting examples is Barclays has been really successful recently, where it's been communicating a range of innovations to great effect. And here I mean by innovations is that they might not necessarily be pure innovations because other banks offer this and have offered this previously, but actually the way they've been communicating them show the benefit to their customers. So really good examples of this are from the card freeze and the PIN reminder, showing that they're using these innovations in a way that can help their customers and be really helpful as a bank. So again, this kind of negates the need to, for some people need to switch to challengers because they offer these functionalities, because actually their bank, which they trust more, can do this and has that much more robustness. So we just want to finish with the key learnings around this. I think first, as we saw, they continue to grow the challenges and do develop, but actually the tipping point is still a way off. The main watch out then is that they do deliver great experiences and they're growing their share of both experience and positive experience. So the real watch out is that if they continue to monitor and maintain these high quality experiences whilst increasing their share, then that puts them in a really great or quite dangerous place. So in the past, a lot of their growth has been driven through earned experiences, so word of mouth. But actually, we saw that trend more recently in the last few months, where they're growing through advertising. I think initially that's going to work well because they can grow awareness, attract new users. But actually, in order to grow into the mass market, we need to make sure that that advertising is really engaging and resonates well with that mass market audience, which our first signs were showing that it wasn't compared to the more established banks. So we saw that they do currently attract a certain audience, but actually when we looked across audiences, their experiences with challenger banks were much better. Some of the key factors which were causing positivity was functionality in terms of controlling spending, savings, endorsements, ease of setting up and ease of use, and also the tone of voice and the communication that was being used. So we saw that they're seen as really innovative at the moment, but actually the test is to make sure that people trust them and to grow their trust perception. And finally, we have seen that banks are starting to respond to this by either freshening their look or changing their communication to show how they can use these innovations or functionalities to benefit their own customers. So that's everything from us today. I'll hand over to Barrett just to say a final few words, but thank you for listening.
Thank you very much. Thanks for giving us your time. Hopefully we'll see you shortly when there are more webinars coming out as a result of the findings from the annual landscape report. Our contact details are there, so if you do have any questions or would like further follow-up, please feel free to contact us through email at those addresses that are on this final screen. Thanks once again and see you shortly. Take care.
Thanks. Bye.